Okay, let's unpack this. Today, we're diving deep into a company that's, well, it's been making some serious waves in the AI world. Nebius Group NV or NBIS. You've sent us a stack of sources, everything from really bullish analyses to, let's say, more cautious viewpoints. And our mission today is to help you cut through that noise, help you understand what's truly important if you're an investor evaluating the stock.
Indeed. Nibius has gotten a lot of attention. Some are calling it a new AI champion, a rising cloud superpower.
Eh.
But then you have others expressing concern, about an unexplainable FOMO, maybe driving its valuation. So yeah, we'll explore these different takes. We'll look at the company's core business, those transformative partnerships, and the financial metrics that really matter, so you can walk away well-informed, ready to make your own decision.
Okay, so let's rewind a bit then, because Nevius wasn't always this, Wall Street darling. What's the real story there? How did it go from essentially bottomed out to this hyper-growth narrative we're seeing today?
Well, what's fascinating here is Nebius's unique foundation. It emerged as an international pure-play AI infrastructure company after divesting its Russian assets back in August 2024. Technically, it's a spinoff from Yandex NV, right? A company with roots stretching way back to 1989. And this heritage gave Nebius a really distinctive software-first culture, plus an experienced engineering team, over 500 people.
Yeah.
That's quite different for some competitors who actually started out as crypto miners. Before this key partnership, one source pointed out its revenue growth was, well, pretty weak. Persistent negative rates, over 90% year over year. It was really a company at a crossroads.
And then came what sounds like the game changer, a huge strategic move. What was that exactly? How did it just suddenly shift Nebius onto this completely new trajectory?
Absolutely. The game changer was, without a doubt, its strategic partnership with NVIDIA. This agreement gives Nebius early and priority access to NVIDIA's cutting-edge Blackwell superchips. Under the deal, NVIDIA actually plans to install over 18,000 Grace Blackwell systems through Nebius by 2026. And what's more, NVIDIA even took a $60 million direct stake in Nebius, part of this whole AI cloud computing services deal. That signals a pretty deep strategic alignment.
Oh, okay. It sounds incredibly strategic, but for our listener, maybe break down what that early access to Blackwell chips truly unlocks for Nebius' services, and I guess by extension for its customers. What does it mean in practice?
Yeah. It's really more than just like an incremental speed boost. It fundamentally transforms what's possible for their AI cloud services. Blackwell chips are described as basically twice as fast as the previous generation. So for example, you look at independent benchmarks like MLPerf Training v5.0. They show these chips are 2x faster when you scale them up for demanding AI training, running between 64 to 128 nodes. And the GB200 Grace Blackwell Superchip NVL72 specifically. That can deliver 30 times faster real-time large language models. 30 times. So this means Nebius can offer vastly improved processing speed, scalability, workload capacity. It also significantly enhances efficiency and, importantly, lowers the total cost of ownership by about 20% compared to conventional AI infrastructure. We're already seeing customers leverage this. Primamente, a biotech company, is using Nebius's AI cloud access for complex epigenetics research. Neurological diseases like Alzheimer's. That kind of work just wouldn't be feasible at this scale or speed otherwise.
That leap in capability, yeah, that sounds like a truly transformative advantage. But, for investors, the rubber really meets the road when capabilities translate into actual financial results. So what kind of immediate impact did this NVIDIA partnership have on Nebius's bottom line?
Oh, the financial impact was dramatic and almost immediate. After the partnership, Nebius's stock price soared 290%.
Wow.
In Q1 2025, revenue growth hit a really solid 625% year over year.
625.
Yeah. And this incredible momentum just continued into Q2 2025. Revenues went from $55.3 million up to $105.1 million. That's year-over-year growth of over 322%. And it led management to actually adjust its annualized revenue rate guidance for FY 2025 upwards. They went from an initial range of $750 million to $1 billion to a higher range of $900 million to $1.1 billion.
That's a powerful signal of confidence, right, from the company itself.
Okay, so they clearly have the cutting-edge tech. They've got this powerful partnership with NVIDIA. But where is all this massive demand coming from? What market opportunity is Nebius really tapping into here, particularly in Europe? Right, and that raises an important question. Why Europe specifically? Well, European organizations are reportedly behind, like 45% to 70% behind in AI adoption compared to other regions. So that signals a massive, largely untapped opportunity. You look at various sectors across Europe, they could see productivity gains generating over $575 billion for the European market by 2030. all thanks to AI, the overall European AI market. It's projected to grow around 24.3% between 2025 and 2033, reaching an estimated $202 billion by 2033, up from about $58 billion in 2025. So it's a continent really poised for an AI explosion, and a lot of businesses are just starting that journey.
That's a huge potential market, yeah. But you mentioned earlier a big hurdle for AI adoption in Europe was cost. So how is Nebius specifically addressing that, especially for, say, smaller businesses?
So right, cost is key. The high cost of implementing enterprise-level AI, often $1 million to $5 million in Europe, compared to maybe $500K to $2 million in the U.S., that's a primary hindrance, especially when, 90% of European businesses are SMEs, small and medium-sized enterprises.
Right.
So the NVIDIA partnership directly tackles this. They offer significant incentives. Think like $150,000 in cloud credits, $10,000 in inference credits for the first 3 months, plus discounted long-term services. And their Nebius Lift program for startups, offering up to $150,000 in cloud credit, that's already attracted over 22,000 members.
Okay.
So it's almost like they're making that top-tier AI compute accessible, bridging that massive cost gap.
Okay, so beyond just cost, what else makes Nebius a compelling choice? What really differentiates them in what's becoming a pretty competitive landscape?
Yeah, their operational model really stands out. Nebius runs its GPU farms in these highly advantageous environments, particularly Finland. The ambient temperature there allows for what's called free air cooling, which results in an incredibly low power usage effectiveness, or PUE, of 1.13. Now, for context, the global data center average is around 1.58, and a PUE closer to 1.0 means vastly less energy wasted on cooling. That translates directly to lower operating costs, and it's a powerful ESG story too, right?
Environmental, social, governance. Important in Europe.
Exactly. And Finland's grid being 90% carbon-free really helps that narrative. Plus, they capture waste heat, they funnel it into municipal district heating, recovering over 50 gigajoule a day annually, which again translates to a materially lower total cost of ownership for their customers. It's a really efficient, sustainable approach.
Interesting. Now, you mentioned sovereign AI earlier. We're hearing that term more and more. For those tuning in who might not be familiar, could you quickly define what that means and why it's becoming such a critical trend for nations?
Absolutely. Sovereign AI basically refers to a country's ability to develop, control, and deploy its own AI infrastructure and models. The idea is reducing reliance on foreign, often U.S.-based giants for sensitive data or critical national applications. It's really about national digital autonomy, data security. So if we connect this back to Nebius, well, many governments are increasingly wary of depending on U.S. hyperscalers for things like defense, critical infrastructure. Nebius's ability to own and operate data centers in these low-cost places, coupled with its software-first DNA and its geographic footprint, Europe, U.S., Middle East, it makes them a kind of natural fit for these sovereign AI programs and for controlled enterprises. They offer hyperscaler-grade compute, but often at a discount. They're even in exploratory talks for joint ventures with countries like Israel and some Gulf states, specifically for this reason, aiming to co-develop localized AI capabilities.
So, okay, we've laid out this dramatic transformation, the exciting market opportunity. We've also peered behind the curtain a bit at the financial realities of scaling this fast. And for an investor, there's always that question, right? Growth at all costs versus sustainable profitability. What does the deeper financial picture really tell us about how Nebius is funding and managing this rapid expansion?
You're absolutely right to look beyond just the top line. It's crucial. While that Q2 2025 revenue was impressive, $105.1 million, up 625% year over year, and yes, annualized recurring revenue is pushing towards $1 billion. The path to sustained operational profitability is, well, it's nuanced. The company did swing to a positive net income, $584.4 million in Q2.
Okay, positive net income sounds good.
It does, but here's the crucial detail. Nearly all of that $597.4 million, to be precise, came from a non-recurring one-off revaluation gain on equity investments.
A one-off.
Exactly. So when you strip that out and other factors, the company still reported an adjusted EBITDA loss of $21 million for the quarter. Now, adjusted EBITDA, that's important because it gives us a clearer picture of their core operational performance, stripping out things like that gain. While it's still a loss, the fact it's down 64% from a year ago, that does show their operational efficiency is improving as they scale. But yes, they are, in essence, burning cash to fuel this incredible growth.
Okay, so despite that impressive revenue surge, operating costs remain high, they're running an operational loss, burning cash. What does that mean for their overall balance sheet, their financial health?
Well, Nebius has a significant cash position. They were holding $1.67 billion in cash and equivalents at the end of Q2. However, that was down about $755 million from the start of the year, although it was actually up from Q1 because of recent financing activities.
Okay.
Their long-term debt stands at $986.2 million. But here's a key ratio. With shareholders' equity of $3.776 billion, their debt-to-equity ratio is 0.261, which is actually quite low compared to the U.S. IT industry average, around 0.48.
So they're not over-leveraged.
Exactly. What this tells us, crucially, is that despite the high spending, they still have significant financial flexibility, room to potentially take on more debt if needed for future expansion. And that's a positive sign for such a capital-intensive business.
Right. That flexibility is important because they are investing heavily, aren't they? We've heard about these ambitious capacity targets. Where's that capital going?
Precisely. Their biggest expense by far is capital expenditures, CapEx, which primarily supports these aggressive purchases of GPUs and related hardware for data center expansion, purchases of property, plant, and equipment, up a staggering 221% year-over-year in Q2.
Wow.
NBIS is aiming to secure over 220 million W power capacity by the end of 2025, and then an even more ambitious 1 gigaW by the end of 2026.
1 gigawatt, that's huge scale.
It is. And this aggressive scaling requires substantial ongoing investment. To fund it, they recently raised $1 billion through senior unsecured convertible notes. That was in June 2025. And that followed a $700 million private placement back in December 2024. So while this clearly demonstrates their ability to access significant financing, it also highlights the extremely capital-intensive nature of their strategy. And yes, they are still burning cash. Some analysts expect they'll need even more funding by early 2026 to hit those ambitious targets. It really puts into perspective just how much capital it takes to build out the future of AI infrastructure.
Okay, this brings us right to the core question for you, the investor listening in. With such explosive growth, but also these significant investments and, mixed profitability signals, what are the different takes on NBIS's stock? Let's start with the bullish perspective. What's the strong buy argument here?
Right. The bullish camp sees NBIS as, well, a quintessential hypergrowth company. They're riding these undeniable secular tailwinds of AI, and they argue that traditional valuation metrics just don't fully apply. Not to a company that's doubling its revenue quarter over quarter and expanding capacity at this incredible rate. Analysts project NBIS's annualized revenue rate could reach, get this, $8 billion by 2026.
$8 billion?
Yeah, based on that 1 GW capacity target and an estimated ARR density, its annualized recurring revenue of about $7.8 to $8.6 million per megawatt. Now, if you apply industry-applicable multiples, say 12 to 15 times ARR, that suggests an enterprise value somewhere between $96 billion and $120 billion, which is, orders of magnitude above its current market cap, indicating massive potential upside.
So for the bulls, it's really all about that future potential, capturing market leadership down the road. What kind of price targets are we actually looking at from that perspective, and what underpins that confidence?
Well, one analyst projects NBIS's stock could more than double in value by 2026. They're targeting $137.66 per share, driven by, continued accelerated revenue growth and improving margins as they scale. Another suggests a fair value maybe around 86 cents a share, which represents over 30% upside from recent levels. And they believe $90 is achievable by December 2026 in a bull case scenario. Noting, of course, it was priced at just $20 back in April 2025.
Quite a ride.
Indeed. They highlight the company's ability to maintain pretty high gross margins, 71.4% in Q2, which is impressive for this kind of business. They also point to its robust expansion plans and those strategic customer wins beyond just NVIDIA. Big names like Cloudflare, Prosus, Shopify, that indicates strong demand.
That's certainly a compelling vision, a strong bull case. But, every investment has its risks, its counter-arguments. What's the more cautious or maybe even bearish view on NBIS? Where do they see potential pitfalls?
Right. The more cautious analyses, they acknowledge NBIS's strong Q2 results, definitely. But they argue that the stock's rally. I mean, seeing surges of 33%, 80% just since may have already priced in a lot of that near-term growth.
Priced in.
Exactly. Concerns include the valuation being described as, frankly, sky high. You look at the forward price-to-sales ratio, it's almost 23. That is significantly higher than the sector median, which is around 3.25. And it even surpasses NVIDIA's historical average of about 18 during its own high-growth phases when NVIDIA was already consistently profitable. So the argument here is maybe the market's gotten a bit ahead of itself.
Okay, and what specific operational or financial concerns do these more skeptical viewpoints highlight?
Well, they point to NBIS potentially reaching what they call peak GPU capacity for 2025. They note that management's CapEx targets actually remained unchanged in Q2. Now, that could suggest either supply constraints from NVIDIA, maybe they can't get chips fast enough, or perhaps a slowdown in their own procurement. Either way, it could bottleneck growth.
Okay.
There are also concerns about the volatility of EPS, earnings per share, and the expected revenue growth deceleration after this initial hypergrowth phase inevitably slows down. They also highlight, again, those increasing operating costs and the continued cash burn, suggesting the company will likely need more funding sooner rather than later, which could lead to further shareholder dilution, right,
Okay.
through more debt or equity raises. It really comes down to the sustainability of scaling that rapidly.
And what about broader market risks or geopolitical factors that could impact a company like Nebius?
Yeah, that's another angle. Some analysts warn about external factors, things like increasing U.S. inflation, uncertain geopolitics generally, even potential 30% tariffs for the EU. That could impact a European-headquartered company like Nebius, maybe by affecting economic growth in its key markets or creating obstacles for infrastructure expansion, equipment imports.
Right, external shocks.
Exactly, and competition. Competition for top AI talent is fierce. Plus, aggressive capital spending from the tech giants Meta, Google, who are also building out massive AI infrastructure, that could force Nebius to increase its own OpEx and CapEx just to keep up, putting more pressure on its financials. And finally, it's worth noting the significant increase in short interest. It went from 9.6 million to 13.2 million shares. That signals that a growing number of investors believe the rally is overextended and are actively betting against its continued rise.
So bringing it all together, what does this all mean for you, the investor, looking at Nebius right now? We've seen a company that's, well, undergone a truly remarkable transformation, driven by this powerful, maybe even unique partnership with NVIDIA, targeting a vast, seemingly underserved market and showing just explosive top-line growth.
Exactly. A very compelling growth story on the surface. But as we've unpacked, there are the financial realities of scaling such a capital-intensive business, the continued reliance on external financing just to fuel that growth, and these highly debated valuation metrics that, frankly, present a significant challenge for traditional analysis. There are genuinely strong arguments for both significant future upside and a real need for caution regarding current price levels and, importantly, execution risks.
So ultimately, this deep dive really highlights that while Nebius is undeniably a key player, maybe even a necessary player, in this AI infrastructure boom, whether it's the right investment for you depends heavily on how you personally weigh these compelling opportunities against those considerable financial and market risks. Risks inherent in any hypergrowth story like this one.
Yeah, and this raises, I think, an important question for your own reflection for anyone considering this stock. What ultimately matters more for a hypergrowth company like Nebius? Is it the accelerating revenue and the capacity expansion almost at all costs, potentially sacrificing near-term profitability? Or is it seeing a clear, sustained path to operational profitability and demonstrating prudent capital management along the way? The answer to that question, how you weigh those two sides, will likely define your investment journey with Nebius.